Factor investing is an investment strategy that involves selecting securities based on specific factors believed to drive their returns. These factors are characteristic traits or attributes that have historically demonstrated a persistent and systematic influence on the performance of financial instruments. Factor investing aims to achieve specific investment goals, such as higher returns, reduced risk, or improved diversification, by focusing on these factors. Key factors commonly used in factor investing include value. Definition. Value investing involves selecting securities that appear undervalued based on fundamental metrics such as price-to-earnings ratio, P/E, price-to-book ratio, P/B, or other valuation measures. Rationale. The value factor assumes that, over time, undervalued securities may outperform the market as they adjust to their intrinsic value. Size. Small cap versus large cap. Definition. The size factor compares the performance of smaller cap stocks, small caps, to larger cap stocks, large caps. Rationale. Historically, small cap stocks have shown the potential for higher returns, although they often come with increased volatility. Momentum. Definition. Momentum investing involves selecting securities that have shown positive price trends in the recent past. Rationale. The momentum factor is based on the idea that securities with strong recent performance may continue to outperform in the short term. Quality. Definition. Quality investing involves selecting securities of high-quality companies based on measures such as profitability, stability, and financial health. Rationale. Quality companies are perceived to have more resilient business models, lower financial risk, and the potential for consistent returns. Dividend yield. Definition. Dividend yield investing involves selecting securities with higher dividend yields. Rationale. Investors seeking income may be attracted to stocks with higher dividend yields, assuming that these companies have the financial strength to sustain and grow their dividends. Low volatility. Definition. Low volatility investing involves selecting securities with historically lower price volatility. Rationale. The low volatility factor is based on the idea that less volatile stocks may offer more stable returns and downside protection, especially during market downturns. Risk. Definition. Risk-based investing involves selecting securities based on their level of risk, often measured by metrics like beta or volatility. Rationale. Investors may target stocks with lower risk as a way to achieve more stable returns and reduce portfolio volatility. Earnings growth. Definition. Earnings growth investing involves selecting securities of companies with strong historical and projected earnings growth. Rationale. Companies with robust earnings growth may be perceived as having strong business prospects and potential for capital appreciation. Factor investing can be implemented through various financial products, including factor-based exchange-traded funds, ETFs, and factor-based mutual funds. Investors can use factor investing to build diversified portfolios that align with their specific investment objectives and risk preferences. It's important to note that factor-based strategies may go through periods of underperformance, and the success of factor investing depends on the investor's ability to accurately identify and exploit the chosen factors in different market conditions.